Assalamualaikum and hi, I am Amirah Binti A.Hamzah.
Assalamualaikum and hi everyone, I'm Ikhwan. So for today's topic, we're going to talk about assertion in classification. As we know, the financial statement should be true and fair, or more accurately, free from material misstatements. But how do auditors obtain complete assurance about the correctness of financial statements? Auditor can't just look at the income statement or balance sheet and put it under the lie detector and test and say, are you lying? So, we're going to look one of the management assertion, which is classification. That management always express their representation about classes of transaction and their related accounts and disclosure. Therefore, the auditor must know this important and understand the management assertion about financial statements to do adequate audits. So, what are you waiting for? Let's get into it.
There are two categories out of three divided by International Auditing Standard and AICPA Auditing Standard that include classification assertion. So the first assertion about classes of transaction and events. Management makes several assertions about transaction, and this assertion also apply to other events that are reflected in accounting records, such as recording depreciation and recognizing pension obligation. The classification assertion addresses whether the transaction have been recorded in the appropriate accounts. Second is assertion about presentation and disclosure, which increases in the complexity of transaction and the need for expanded disclosure about this transaction. Assertion about presentation and disclosure have increased in importance. In these categories, the classification and understandability assertion relates to whether amounts are appropriately classified in financial statement and whether the balance description and related disclosure are understandable. For example, management asserts that the classification of inventories as finished goods, work in process and raw materials is appropriate, and the disclosure of the methods used to value inventories are understandable.
Alright, now we will go further in details of general and specific objective for classes on transaction, accounts and disclosure. For the first part, which is transaction, is related about the audit objective. For the classifications, which means transactions included in the client journals are properly classified. This objective addresses whether transactions are included in the appropriate account. For example, misclassification for sales are including the cash sales is included as the credit sales. Recording a sale of operating fixed assets as a revenue, and misclassifying commercial sales as residential sales. Alright, for the second part is general balance, which is related audit objective. In classification means amount included in the client listing are properly classified. This is to determine whether items included on the client listing are included in correct general ledger accounts. For example, I can give you as account receivable listing, and receivable must be separated into short term and long term, and amount due from the affiliates. Officer and director must be classified separately from amount due from customers. And the most important part is the classification balance. This related audit objective is closely related to presentation and disclosure. They are related audit objectives, but more relate to how balance are classified in general ledger's account, so they can appropriately presented and disclosed in the financial statements. So for the specific objective, I give to Amirah to explain more about that.
After the general transaction related audit objective are determined, the specific transaction related audit objective for each material class of transaction can be developed, such as classes of transaction typically include sales, cash received, acquisition of goods and service, payroll and so on. Same goes for the general balance related audit objective. After they are determined, the specific balance-related audit objective for each account, balance on the financial statement can be developed.
Plug Power will restate financial statements for the last 4 years. That news came out at the end of the day on Tuesday. Diving into this article, Plug Power, the hydrogen fuel cell company that reported GAAP losses and negative revenue in its most recent quarter, well, they announced some accounting issues and that sent their stock tumbling. They were supposed to file an annual report with the SEC, or Securities and Exchange Commission, but they said they needed an extension. They said they needed a little more time to crunch numbers, and apparently it's because they're going to restate fiscal years 2018, 2019, and their quarterly filings for 2019 and 2020. And here's what investors don't like to see. When they were working with their auditor, they discovered errors in accounting. And you're going to see a bunch of phrases that look kind of scary. Plug needs to fix the book value of right-of-use assets and related finance obligations, loss accruals for certain service contracts, impairment of certain long-lived assets, and classification of certain costs, including costs related to research and development. I think we're going to need a lot more clarification here, but at this time, the only thing management really wants us to know is that they do not expect the restatement to affect Plug's cash position or business operations. And they said these are just errors, it's not misconduct, no one did anything malicious here, no one did anything to try and defraud investors.
Let me explain more about the real life case that can be related on our today's topic, which is assertion and classification. So on 17 March of 2021, the Plug Power share sells off after auditors required restatement of financial results. These results avoid the stocks. So what is going on at the Plug Power? First of all, it is important to note that required restatements are not expected to impact the company cash position and business operations. Management actually affirmed the company highly ambitious longer-term financial targets in the press release. Under the new account standards, Plug Power is required to recognize a so-called right of use of assets and a corresponding lease liability, or in a simpler word is finance obligations, on the balance sheets based on the present value of future lease payments. Apparently, something went wrong in the termination process and the company overstated both the right of use assets and the corresponding finance obligations. Consequently, Plug Power will be required to reduce this position on the balance sheets.
In short, the company has overstated the gross margins by incorrectly allocating cost of goods sold to research and development expense. Depending on the magnitude of the restatement, the company's real gross margins might be considerably lower than previously reported. While there won't be a change to reported earnings from this restatement, the investors are unlikely to be enthusiastic and the company investing considerably less in research and development than previously stated. Furthermore, the increase in cost of goods sold might actually be another reason behind the above discussed requirement to record additional loss accruals for service contracts. With the service business already operating at negative gross margins on a full year basis, the requirement to record additional costs might indeed have caused auditors to look at the company's service contracts with increased critical observation or examination.
So that's all about assertion regarding classification for today. Thanks for watching. As always, if you are after more videos, just please subscribe the button below, and if you find out the videos are useful, just hit the thumbs up button. You can find out lots of videos on our YouTube channel. So, I'll see you next time. Peace out.